In this video, I'm going to reveal the 5 key distribution rules for S corporations in Florida that every business owner must know. And if you're running an S-Corp in the Sunshine State right now, understanding these rules could literally save you hundreds of thousands of dollars in taxes and penalties, or cost you dearly if you get them wrong. I'm Santiago Cueto, board-certified international business law expert and best-selling author. And in my decades of practice helping business owners navigate complex tax structures, I've seen too many S-Corp owners make costly mistakes with distributions simply because they didn't understand these fundamental rules. So stay with me, because by the end of this video, you'll know exactly how to structure your S-Corp distributions to maximize your tax benefits while staying completely compliant with both federal and Florida law. And I guarantee you, rule number 4 is going to surprise you. It's the one that trips up even experienced accountants. But first, let me ask you this. Are you taking full advantage of Florida's incredible tax benefits for S-Corp owners? Because unlike most states, Florida has no state income tax, which makes S-Corporation distributions even more powerful here. All right, here's rule number 1, the reasonable compensation requirement. This is absolutely fundamental, and the IRS is watching this one closely. Before you take a single dollar in distributions, you must pay yourself a reasonable salary as a shareholder employee. You see, Florida law specifically requires this, and federal law is even more stringent. So here's what reasonable means. You need to pay yourself what you would pay an unrelated third party to perform the same services. The IRS looks at factors like your training experience, duties, time devoted to the business, and what comparable businesses pay for similar services. I've seen the IRS reclassify distributions as wages when they determined the salary was too low, resulting in back payroll taxes, penalties, and interest that can devastate a business. A good rule of thumb? Many tax professionals use the 60-40 approach. 60% salary and 40% distributions. But this isn't an IRS rule. This is just a starting point. The key is documentation. Research comparable salaries in your industry and location. Document your decision-making process and gradually increase your salary over time based on business performance. Here's rule number 2, the stock basis limitation. This rule determines whether your distributions are tax-free or taxable, and it's absolutely critical to track this correctly. Your stock basis starts with your initial investment in the S-Corp and gets adjusted every year. So here's how it works. Stock basis increases with your share of corporate income and any additional capital contributions you make. It decreases with distributions, your share of losses and non-deductible expenses. The golden rule: distributions can only be taken tax-free up to your stock basis. If you take distributions that exceed your stock basis, the excess becomes taxable capital gains on your personal return. So for example, if your stock basis is $50,000 and you take a $75,000 distribution, the first $50,000 is tax-free, but that extra $25,000 gets taxed as capital gains. This is why tracking your basis annually is so important. It's the shareholder's responsibility, not the corporation's. Now here's rule number 3, the ordering rules for basis adjustments. The IRS has specific ordering rules for how stock basis gets adjusted each year, and getting this wrong can cost you dearly. This happens annually as of the last day of the S corporation's tax year. So here's the correct order. First, increase stock basis for all income items. Second, decrease basis for distributions. And third, decrease basis for non-deductible expenses. Finally, decrease basis for losses and deductions. So why does this order matter? Because if you have both distributions and losses in the same year, the order determines how much of the loss you can actually deduct. Following the wrong order could mean losing valuable tax deductions or accidentally making distributions taxable when they should have been tax-free. Now, I've seen shareholders lose tens of thousands of dollars in deductions simply because they or their accountant applied these wrong adjustments. Now, if you're getting value from this so far, hit that like button. It really helps other S-Corp owners find this critical information. And make sure you stay until the end, because rule number 5 could completely change how you think about S-Corp distributions. Now here's rule number 4, the debt basis opportunity. This is the rule that surprises most people because it can actually expand your ability to take tax-free distributions and deduct losses. When your stock basis hits 0, you can still deduct additional S-Corp losses if you've made direct loans to the corporation. But here's the key. It must be a genuine loan directly from you to the S-Corp, documented with a written promissory note specifying terms, interest rate, and repayment structure. Personal guarantees on bank loans don't count. Loans from entities you own don't count. It has to be your money, directly loaned to the corporation. If you use debt basis to absorb losses, there's a restoration rule you need to know about. When the S-Corp has future income, that income must first restore your debt basis before it can increase your stock basis. And if the corporation repays a loan where your basis has been reduced, you could have taxable gains on the repayment. This is sophisticated tax planning that can provide significant benefits, but it does require careful documentation and ongoing tracking. All right, everybody. Now here's rule number 5, Florida's unique advantages. Here's what makes S-Corp distributions so powerful in Florida. There's no state income tax on individuals, LLCs, or S corporations. This means your distributions avoid both federal self-employment taxes and any state income tax. However, don't forget about other Florida requirements. You still need to file an annual report by May 1st with a $150 filing fee, and depending on your business type, you may have sales tax or other obligations. The combination of no state income tax and the federal S-Corp tax benefits makes Florida one of the most tax-advantaged states for S-Corporation owners, but only if you follow these distribution rules correctly. Remember, you'll receive a Schedule K-1 each year showing your share of income, losses, and distributions. This flows through to your personal tax return, and while distributions aren't subject to self-employment tax, they are still subject to regular income taxes. These 5 distribution rules can make the difference between maximizing your tax savings and facing costly IRS penalties. Now, if you find this breakdown valuable, make sure to like this video and subscribe to my channel for more tax and business law strategies that protect your wealth and keep you compliant. Because in the world of S corporations, what you don't know can definitely hurt you. See you in the next video.